Buy cheap stocks and sell them when they're expensive. Buy low, sell high. It sounds simple, but does it actually work? And if buying cheap companies is such a reliable strategy, why has the value factor had such long periods of underperformance? That is what we're going to unpack in this video. To put things into context, this is the second video in my revamped factor investing series. Most of us have heard the saying to just buy the market. In my own portfolio, that is what I do with the majority of my investments. Global market cap weighted index trackers are simple, low cost, and diversified. Over the long term, they have delivered excellent results for many investors. However, alongside that core, I like to explore research-based tilts and strategies. Decades of studies suggest that certain characteristics have been linked to higher long-term returns. These characteristics are called factors. Things like quality, value, momentum, size, and minimum volatility. The good thing is that today we do not have to read the academic papers and then try to replicate them manually in our portfolios. We can access these tilts through ETFs that claim to give factor exposure. Since my last series, new ETFs have been launched and the market backdrop has shifted, so it's a good time to revisit these ideas. In this video, as I said, the focus is on value and we'll break down what exactly value is, why a premium might exist, the UCITS ETFs available today, why value has struggled for long periods, and what you need to know before considering a value tilt. As always, remember that I'm not a financial advisor and nothing in this video is financial advice. This is for informational and educational purposes only. When investing, your capital is at risk and past performance doesn't guarantee future results. So, with that said, what actually is the value factor? In the simplest terms, it's about tilting your portfolio towards companies that look cheap relative to their fundamentals. This could be based on a low price to earnings ratio, a low price to book ratio, strong cash flow relative to the share price, or other valuation metrics. There is no single definition of value, which is part of what makes this factor interesting, but also more complicated than it first appears. Unlike quality, which focuses on companies that are strong and profitable, value focuses on companies that are priced cheaply by the market. These are often firms that have gone through a difficult period, have lower growth prospects, or have simply been ignored because investor attention is focused elsewhere. Historically, value investing goes all the way back to Benjamin Graham, who is often called the father of value investing. His philosophy was built on the idea of buying companies for less than their intrinsic value and waiting for the market to correct that mispricing. The academic research on value really took off in the late 1970s. One of the most influential early papers was by Basu in 1977. He found that companies with low share prices relative to their earnings delivered higher returns than you would expect under the efficient market hypothesis. In other words, cheap stocks tended to outperform. Then, in 1981, Rolf Banz examined the relationship between stock returns and company size. And while his paper is more famous for the size effect, it also added to the growing discussion around market inefficiencies and why certain types of stock behave differently. But the landmark moment came in 1992, when Eugene Farmer and Kenneth French published their paper showing that companies with low price-to-book ratios tended to outperform companies with high price-to-book ratios. This was one of the clearest demonstrations of a value premium in the data, and it became a core part of the Farmer and French three-factor model. The intuition behind value is quite simple. Investors tend to overpay for exciting growth stories and underpay for companies that look boring, old-fashioned, or out of favour. As a result, some cheap companies end up being undervalued relative to their fundamentals. When expectations eventually normalise, these companies can outperform as the market reprices them. So that is the basic idea behind value, a systematic tilt towards companies that appear cheap based on their fundamentals, backed by decades of academic research, but implemented in many different ways depending on which valuation metric you choose. So why might a value premium exist in the first place? There are two broad explanations in the research. One is risk-based and the other is behavioural. They're not mutually exclusive and both have evidence behind them. The risk-based explanation is that value stocks often look cheap because underlying businesses are riskier. They can be more cyclical, they may be carrying higher levels of debt, their earnings might be unstable, or the market may be worried about long-term decline in the industry they operate in. In other words, value stocks may be fairly priced, but investors demand higher returns as compensation for holding companies that could be in distress. The other explanation is behavioural. Investors as a group have a tendency to extrapolate recent growth too far in the future. When a company is growing quickly, expectations can become unrealistic and the share price can move far ahead of fundamentals. At the same time, companies that have disappointed or gone through a difficult period can become neglected. The market may overreact to bad news, assume the worst, and mark the shares down too far. If the situation improves even slightly, the valuation gap can close, and these cheap stocks can outperform as expectations normalize. Both explanations are compelling, and the reality is it's probably a mix of the two. What we can say is that the historical data shows long periods where value has outperformed and long periods where it has lagged. That tells us that, whatever the reason, this is not a factor that works all the time, as with any of them. It's cyclical, difficult to hold emotionally, and, as we'll see now, implemented in different ways. Before we move on, I'd like to take a moment to thank Trading 212 for sponsoring today's video. I've been using Trading 212 as my main stocks and shares analysis provider for a while now, and it really is one of the most competitive options out there. First of all, when it comes to fees, they offer zero custody fees, zero commission on trades, and a super low foreign exchange fee of just 0.15%. Then when it comes to choosing investments, there's over 13,000 stocks and ETFs to invest in, so you really are spoiled for choice. Their app is one of the easiest to use on the market, and it's frequently updated. As a couple of examples recently, the homepage was revamped. You can see your investments, cash, and watch lists all in one place. And they also, in the last week or so, revamped the search bar. So when you search for stocks and ETFs, you can then filter using stocks, ETFs, and other categories. So it makes it super easy to find the investment you're looking for. If you'd like to try out Trading 212, you can get a free fractional share worth up to £100 by signing up via the link in the description. Or if you're watching on TV, you can scan the QR code on screen and sign up that way. Alternatively, within 10 days of opening your account, you can go to the menu page, use promo code, type in Tom, and if you use that code, you'll get your fractional share. Thank you again to Trading 212 for sponsoring today's video. Let's now take a look at some of the value factor UCITS ETF options that are available to us as UK and European investors. These are not recommendations, just examples used for illustrative and educational purposes. Please do your own research, and as I go through these funds, I'll highlight some of the challenges and trade-offs with each one. First up, we have the iShares Edge MSCI World Value Factor ETF, ticker IWFV, and the Xtrackers MSCI World Value ETF, ticker XDEV. Both have total expense ratios of 0.25%, which is higher than a plain MSCI World Tracker, but relatively typical for a factor ETF. As I mentioned in the quality video, we should never go off the name of an ETF. You might reasonably assume that these track the MSCI World Value Index. They do not. They both track the MSCI World Enhanced Value Index. MSCI define value for this index using three measures: price to book value, price to forward earnings, and enterprise value to cash flow from operations. If you want to learn more about the index, I would recommend simply Googling the index name and reading the fact sheet. MSCI update their materials monthly, so it's better to look at the latest version yourself. One very important detail here is that the index employs sector neutrality. That means that overall sector weightings of the ETF will look very similar to a standard MSCI World ETF, but the holdings inside each sector shift towards cheaper companies. So in the tech sector, for example, whilst it will have the same weighting, you'll not see companies like Nvidia or Microsoft because they're expensive on valuation metrics. Instead, you'll see companies like Cisco, Intel, or Qualcomm with significant weighting. Whether you see that as a positive or a negative is up to you. In the most recent 5-year period, the iShares and Xtrackers ETFs have been slightly ahead of a standard index tracker, but only marginally. And of course, past performance is not a guide to the future. Next, we have the SPDR MSCI World Value ETF, ticker VALW, VALW. Again, the name is slightly misleading because it does not track the World Value Index. It tracks the MSCI World Value Exposure Select Index. The fee is also 0.25%. MSCI described this index as aiming to represent companies with relatively higher value exposure, whilst also seeking to avoid poor quality companies. So essentially, this is a blend of value and quality. Some investors will like that because one criticism of value investing is that pure value screens can result in portfolios full of low quality or distressed companies. The top 10 holdings look very similar to the Enhanced Value Index though. This ETF is also sector neutral, which means the same constraints and trade-offs apply as the iShares and Xtrackers ETFs. If you compare VALW with IWFV and XDEV over the past 5 years, the performance has been very similar. It's hard to say whether there'll be any meaningful differences going forward, because in practice, the exposures have behaved very similar recently. There are other types of value ETFs that exist as well, such as small cap value ETFs. These combine the value and size factors. I've covered those in a separate video. Some researchers argue that value works best when paired with size, but that is a deeper topic and outside the scope of this video. There are many more ETFs I could have mentioned, but the goal here is not to list every product. It's to show that it's important to look beyond the name, read the index methodology, understand which valuation measures are used, look at whether the index is sector neutral, and while past performance can be a useful context, remember that factors rotate and 5-year charts may not tell you much about long-term expectations. Moving on, value has one of the most frustrating performance histories of any factor. Over the very long term, it has delivered periods of strong outperformance, but the last decade or so has been extremely difficult. Low interest rates, strong growth in technology, and weak performance from certain sectors high in value stocks. Meanwhile, expensive growth stocks kept getting more expensive. That environment made it look as if the value premium had disappeared. Things started to shift in 2022 when inflation and interest rates moved higher. Financials and energy companies, which were trading at very low valuations, did perform quite well. At the same time, some of the mega-cap growth stocks saw their valuations reset. This helped value close some of the gap, and in certain periods recently, it has been the strongest factor. This year, 2025, is one such example. Value has done well, and a big part of the rebound has simply been banks doing well from a higher rate environment. Banking stocks have had a very strong rebound. The key point here is that value is cyclical. It can lag the market for long stretches and then recover quickly when conditions change. 5-year charts can be misleading, and a decade of underperformance does not necessarily mean the factor is broken. What it does show is how difficult value is to stick with, especially when the headlines are dominated by fast-growing companies. This leads us on nicely to the challenges of implementing value in a real portfolio, because this is one of the hardest factors to stick with. The first challenge is value traps. A company can look cheap on paper because its fundamentals are genuinely deteriorating. The share price might be low because the business model is under real pressure. Pure value screen does not always distinguish between a bargain and a company that is cheap for a very good reason. Then there are the long dry spells. Value can underperform the market for years at a time, even a decade or more. Most investors underestimate how hard that is to sit through. I know I did. It's one thing to read about long-term premiums in a research paper, but it's another thing to watch your portfolio trail behind a simple global tracker year after year. Fees are another consideration. Value ETFs are still more expensive than vanilla index trackers. Even though fees have come down over time, the difference does compound and can eat into the already uncertain premium. And finally, there are no guarantees. The historical value premium may shrink or even disappear. We have to remember that past performance does not guarantee future results. These challenges do not mean that value cannot work, but they do highlight the importance of understanding what you're buying and being realistic about the behavioral commitment required. So that brings us on to the end of this run through of the value factor. It's one of the oldest and most researched ideas in investing, but also one of the most controversial. The academic theory is strong, but in practice, the experience can be very different. If there's one key takeaway, it's that value requires patience. It moves in cycles, it can lag for a very long time, and it tests your discipline in a way that a simple global tracker does not. Sticking with it through those difficult periods is the hardest part, and it's something most investors underestimate. In the next video in this series, we'll look at the momentum factor, how it works, and how it behaves in a portfolio. It's a very different idea to value, but also just as fascinating. If you found this video helpful, consider leaving a like and subscribing. It really helps the channel. And as always, remember that this is not investment advice. When investing, your capital is at risk, and past performance is not a reliable guide to the future. Thanks for watching, and I'll see you in the next one.